Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Moneeka Sawyer.
Today, I am so excited to welcome to the show Stefan Tsvetkov. Stefan is the founder of Realty Quant at realtyquant.com, a company that brings data-driven and quantitative techniques to the real estate industry on a mission to add industry value through education, investment, technology, and analytics. Financial engineer turned multi-family investor, analytics speaker, and live webinar host, he holds a master's degree in financial engineering from Columbia University, and during his finance career managed $90 billion with a B, $billion of derivatives portfolio jointly with colleagues. Wow, those are some big words. Featured on multi-podcasts and webinar events, including Elevate, Best Ever Real Estate Show, Investing in the USA. I love that one, by the way, with Reed, and host of Finance Meets Real Estate webinar series. Welcome to the show, Stefan.
Great introduction. Thanks for having me, Moneeka.
Yeah. So derivatives, that's a stocks term, right? I just wanted to let people know what that is. That's options, basically, if you don't know anything about it. But
options, futures.
Options and futures and that sort of stuff. So you got kind of a wide variety of financial experience, kind of like me. I used to manage a bunch of derivatives and stuff like that too. So such an interesting thing. We don't see that on this show very much. So tell us a little bit about you. Give us a kind of the 2-minute version, the executive version of how you got to where you are investing in real estate and why you love talking about sort of the analytics.
Yeah, absolutely. So like you mentioned, I'm a financial engineer. So originally I'm Eastern European myself. I came to the States. I went to Columbia in New York for my graduate degree. I worked in the financial industry for about a decade. And in the recent 2-3 years, I've been a real estate investor as well as founder of a technology and analytics company in the real estate industry called Realty Quant. So I talk on analytics as related to that. We publish market valuations data as for like how over, under, fairly valued different markets are. And I also do data-driven investing and build like different technology and tools in the industry for that.
Got it. I think we've had one person come on and talk about data-driven real estate. He wasn't actually an analyst. So this is really exciting. So don't be shy talking numbers. We can handle it. And I'm super excited to hear sort of how you run this. So first, let's define data-driven real estate investing.
Yeah, data-driven real estate investing, it's a great question. So what it is, it incorporates like different, kind of data science or like technology techniques for investing and discovering like inefficiencies and discovering opportunities in the real estate market. A big part of that is automated underwriting. So automated underwriting is like, can you, pull thousands of on-market, off-market listings and underwrite them, but even to a partial extent. And, later you would perhaps need to, obviously view the property in person and so forth, but it's still like at least this preliminary analysis. So automated underwriting is a big part. So to that, there's like different like machine learning also that comes into play a bit, like things like computer vision, like are you able to now process images, real estate images, and kind of define the condition of those properties? So condition scoring based on real estate images, based on textual descriptions or extracting other intelligence from textual descriptions. There's some modeling also for like financial modeling for like off-market inventory, such as in the commercial multifamily space, that is very useful. It's a set of techniques for finding deals, finding markets. On the market side, it's also kind of like gauging valuation. So having like appreciation predictors and downside predictors for your markets. And that's all like very useful in the commercial multifamily space, as well as in the residential investing to kind of, be able to gauge like markets and pick the best ones and so forth. So that's what data-driven investing is. It's a slightly different approach than the more local real estate investing, which there are very good reasons for that, such as you want to be vertically integrated, you want to like have your team within a location, you want to understand that location really well and so forth. But data-driven investing is more agnostic a little bit to that and does try to gauge those markets in a bigger way, kind of, and like be able to scale and do this like across anywhere in the US. So that is the difference. It's also like getting your own intuition with the data rather than, let's say, reading reports. That's not data-driven in my mind. So let's say if you just purely looking at reports, it could be, but it's a little bit hard without also interacting with the data yourself or an analyst on your team doing it and so forth. So it takes like bigger insights with that.
With reading of reports, you think it takes more insights?
More insights than just like summary reports of what are, let's say, best markets in the US for this and that. It's not, in my experience, at least, that's not a very, you need like literally the whole data for whole US, like everywhere, it's like, it's a bigger endeavor.
Mm-hmm.
So.
Interesting. How did you get started investing in real estate? I want a little bit of context. Like, how did you get started and why did you move from where most of us are, right? Where we're looking at reports, we're listening to the news, we're trying to invest locally because those are markets that we understand, right? So that's kind of the more intuitive way that most of us invest. And you moved to more data driven. So could you give us a little bit of your journey? Like, how did you get started and how did you get to where you are now?
Yeah, great question. Well, I mean, first, so I'm in New York. So the first property I bought was kind of like house hacking strategy, that many people are familiar with. So I bought like a multifamily close to the city in New Jersey, and I kind of lived in one unit, rented out the other one. So I thought it's working well. There was like a bit of a discount to the price as well and so forth. So I thought I should look into it more professionally and kind of find like investment opportunities as a professional investor. And so from there, I started as a residential investor, like doing like condominium conversions in the New York City area and other projects. So I started kind of pulling lots of data. So I pull like perhaps 6,000 like on market, off market properties within 3 hours from New York City. And I would have them underwritten on different strategies. So it's not only that, okay, then you can compute your cap rates, compute like different things like that. But it's also, you can underwrite on strategies that, it's otherwise it's just hard to think about at such scale for so many properties, such as condo conversions or perhaps converting a residential to a commercial property and so forth. And so that was kind of like the way I started. So I've been doing like residential deals in the New York City area, in the small multifamily space, like very close to markets like downtown Jersey City, like Weehawken, like very close to the city, and some upstate New York. And from there, I've been transitioning to the commercial multifamily space in the Midwest and like looking for different deals in places like Iowa, Minnesota, and sort of like more fairly valued markets at the current time.
Okay. And so when you moved out of New York, basically is when you started becoming more data driven. Is that true?
No, I'm still physically in New York. I was data driven when investing around the New York City area as well. So I would do like residential listings.
Got it.
Yeah, for many. But when more recently transitioning to commercial multifamily, the market side becomes more and more relevant, of course, because now you're not only in your local market, you want to pick the best markets out of state. There's also concerns for, are they overvalued, if we're going to have a recession and things like that. And so, that kind of prompts some of that analysis on the market side.
Perfect. That's a perfect segue. So let's talk about how to determine if a market's overvalued or kind of what is the downside risk, right? Let's talk a little bit more about that.
Yes. And that's a really important question. It's like a kind of $1 million question if you think about it, because think about like ahead of the global financial crisis. So ahead of the global financial crisis, there were investors who invested in, for instance, California or Nevada, and those had a 50% decline, roughly speaking, and they sort of lost, and they were extremely successful investors. And that's kind of more speaking to the residential kind of like single family space, just for this discussion. Because, commercial multifamily, it's a bit different. It's driven also by dynamics of cap rates and so forth. And so like those investors, some of them lost all their net worth. And those were some of the biggest investors in the US, not biggest investors, let's say biggest, I would say like people you watch on podcasts in the US.
Yes.
Very biggest ones, but, like that were extremely successful. And they were extremely successful with their operational process. They knew how to find deals. And yet they lost a lot of their network. And the reason is, those markets were extremely overvalued. And on the contrary, there are others. And for instance, so I run my own webinar, and Okay, I'm not going to mention him. So one of the bigger investors, bigger syndicators right now. So he purchased his property in, I believe, Midlands, Texas was his first syndication. He had a super huge return. And the reason is, well, Texas was undervalued. That's ahead of the global financial crisis, just kind of like backwards discussion. And it was undervalued, and undervalued markets at the time, they didn't decline. They declined like now, they did decline, but 4% average. So they declined very, very little. They declined on their income, sort of say in valuation terms, like normalized terms, they didn't actually.
I just want to highlight some interesting things that you just said. So an overvalued market, which decline are you talking about? Do you talk about 2008, 2009, like during that time?
That's
what you're referring to. I've been through 3 of them, so I just want to make sure I knew which one you were talking about. And in that one, so you see in markets like California, many of the markets in California, right, we were very, very overvalued. And so you saw, and I tell this story on my podcast many times, in 3 months, in 2009, 2008, my goodness, I'm like spacing on it because it was so painful. But I lost 50% of the valuation of my properties in a period of 3 months. Like things dropped so fast, right? So now you go to a market like what he's talking about in Texas, and it's not overvalued. It still did have a response to the crash, though, but it was only 4% is what he's quoting us at, right? So when we're talking about the difference between it doesn't mean that the other markets don't move. They just move. It's a gentler move down, and then the correction is much more easier to make that happen, right? In California, we saw a correction. It took about 6 or 7 years, and not all markets recovered. Only some of them recovered. So location was a really, really big deal. And I don't know the rest of the country, but just based on what you just said, I just wanted to point that out, that it's not that because you're in a low risk market that you're not going to see a drop. It's just that it's a much gentler drop in response to sort of the national or international crisis that we had, right?
Correct. But in some, if it's an extremely very overvalued market, for instance, like some markets were in North Dakota at the time, they could actually see no drop at all as well. They could see 0 drop. That was during the global financial crisis. And so, so across like about 10 US states that were undervalued. And again, since you asked me, what is the definition? So the definition is essentially like price deviating from fundamentals of income, population, housing supply. So that is so essentially this is fundamental analysis similar to the stock market, right? The difference being in real estate, it actually works well. And so the back study that I did for global financial crisis, so correlation for state level declines was 85%. For metropolitan areas, correlation is 89% of market valuation at the peak ahead of the crisis and subsequent price declines. So this is huge. So this is extremely important for investors now. So I did a back study for the past 3 recessions. So global financial crisis being one of those 3 recessions. So at the global financial crisis, the correlation for the metropolitan statistical areas, MSAs, was of declines of the market valuation at the peak ahead of the global financial crisis. And price declines peak to bottom over the next roughly 4 years and 1 quarter on average.
Okay.
There are different periods in different regions, but those declines that took like 4 years forward. So the correlation between the magnitude of the declines and the valuation was 89%. So that's huge.
Yeah.
So basically declines were predictable in magnitude ahead of the global financial crisis. There were people who were talking about it at the time. I don't want to go into too much detail. Like Ingo Windsor is a guy in Massachusetts. Like he runs a company called Local Market Monitor. I believe he was on CNN in 2005, 2006, and so forth. But just common investors don't use it. This is practiced by like larger institutions, done by Moody's Analytics. There's a study at Florida Atlantic University and so forth. And it's done by my company, Realty Quant. So we publish the data. So just for like your audience benefit, we do publish the data for every U.S. county.
Okay.
And so we had for 2,700 U.S. counties. So basically we have like every single county, if it's over, under, fairly valued. And that is a statistical predictor of declines post-recession. It's a really important one. And another thing I want to share, if you would allow me, I'm not sure if it's a good time to share my screen to kind of show a table on this.
Sure. So, ladies, he asked me for permission to share his screen. I said yes, because those of you that are going to check this out on YouTube, you get the visual benefit of this. But he is going to walk us through this. So if you're audio only, don't worry, he's going to walk us through this. But this also might be a good time to go check things out on YouTube. You can look me up, Moneeka Sawyer, and you'll see all the YouTube things. Oh, also, if you go to blissfulinvestor.com, every single podcast has the YouTube embedded in the blog post. So you can search for this there also. So blissfulinvestor.com is another place to go. Okay, Stefan, it's all yours.
Perfect. Thanks, Moneeka. That's awesome.
It's a lot of numbers. Yep.
So that's a big table, a lot of numbers. I'm gonna just give you the gist of it. So what I'm showing here is 10 years ahead appreciation or like price changes in metropolitan areas in the US and just like for the listeners, so I'll just share. So these are like how different markets perform after a mild or a severe recession for 10 years forward, based on how over or under or fairly valued they are at the peak ahead of the recession. So again, so just to repeat, so this is how different markets perform for 10 years forward, based on their valuation currently, based on how overvalued they're at the peak of a recession, or call it currently, but kind of at the peak of a recession, how different markets perform following that, and also in a mild recession, such as the 1990 recession is kind of referred to by most economists as a mild recession, and the global financial crisis is kind of like a scenario for a severe recession. So this is like what this table shows. It's a lot of numbers, but it's extremely interesting because that gives a perspective for many investors now so as most of you know, like at the current time, like investors go to, have had the price performance in Western and Southern markets. So one huge implication of that this table here is the most booming Western and Southern markets, which are now at valuations so if you look at like the first column in the table, it shows like overvalued percentage. So the current valuations in like some Western and Southern markets are in the, call it 20 to 30, some are like 40 to 50% range. Okay. Overvalued. So this
one actually has a picture of the United States and all the different states and markets. So we've got a little bit more clarity on which states he is talking about.
So this is showing like a picture of the US and like what is the overvaluation or undervaluation in different US states. Based on, again, this is like deviation from fundamentals. So that's showing is like the dark blue kind of states in the picture. They're to the west and to the south. And so Idaho is, for example, a pronounced thing at the top. It's been reported by Moody's Analytics and other studies. Basically, consistent observation for everyone is the most overvalued US state, with Boise, Idaho being the most overvalued city in the US.
Wow.
So that's fundamental analysis. So that's like, it's you can even done in different methodologies by Mark Zandi, chief economist at Moody's, and others, or Realty Quant in my kind of my capacity, so to say, and other companies. It's generally consistent. Boise is at the top of like 800 US cities. And so that's like kind of Idaho is like over 50% overvalued. So just to give an example, and then on the contrary, like the Northeast and Midwest are kind of under to fairly valued even now. And so these valuations have been accelerating a lot with inflation since 2021, starting with basically what was a fairly valued US market at the time. And so, but what I'm trying to say is, and I know it's a lot of numbers, but it's extremely important. And I could actually, I could put like a lot of work on that myself is, well, it's not to get like a doomsday perspective of, okay, if let's say Western market, let's say take Idaho, Nevada, Arizona, Utah, Colorado. So they are overvalued to an extent. Now, less so than Idaho, but still to an extent. So if we take those, not to take a doomsday perspective, like I speak a lot to investors and syndicators who say, okay, we think these markets, they have such strong fundamentals. Okay, even if they have a bit of a decline for some time, let's say they have a 5-10% decline or something, they're going to do well afterwards because they have such strong fundamentals. There's so much job growth there, all those things. But that's not what the history suggests, because what happened in the previous recessions was markets that were at the very peak of valuation. So let's say, suppose we take Idaho at 54% overvalued. And we look at like, I'm just showing a table that shows like valuation ranges, how overvalued different markets are, and how they perform for 10 years ahead. And so markets that were in the 50 to 60% range, they were extremely booming ahead of time. So for instance, the 1990 recession, and even if it's a mild recession, so let's just take it's a very mild recession. We have nothing doomsday ahead. We have the mildest recession of 1990. Nobody even knows about as far as real estate declines. Okay, right? It's a very mild.
I know about that one, by the way. I lost 20% of my value, just so you know.
Okay, I mean, so let's say it's a very mild recession. There's nothing terrible happening in U.S. real estate, but one invests in a metropolitan area that is valued at 50 to 60%, which is the case of few metropolitan areas in Idaho and like some other states. And so what happens there? So what happens is not the situation of, okay, it's a mild recession, the market declines quickly a little bit and jumps back. What happens is the market declines, yes, a little bit, such as here, only 14% was the decline at the time. Mm-hmm. But it doesn't jump back quickly. It takes a long time for that decline to happen. And so in that case, it took 8 years. And what is more important is what is the relative performance over 10 years of a market like that was overvalued versus the other ones. And so, for instance, in this case, like all the markets, metro areas that were overvalued 56%, they only appreciated a little bit, 16% over 10 years. They were heavily outperformed by the undervalued ones. Mm-hmm. That is very not intuitive. That's not what people are imagining now for Western and Southern extremely booming markets. Right. They're imagining that those are fast markets. The Midwest are slow markets, and like other places are like slow markets that they're just steady. Mm-hmm. They're not slow and steady. They are expected to outperform in a recession. And so here, essentially, it's very interesting, actually, and that's why I kind of want to show this table, that actually undervalued markets following a recession outperformed the overvalued ones. And it's very important to know that the overvalued ones, those were the booming, they were also the top performing ones ahead of the recession. Because ahead of a recession, correlation between how overvalued they are and how well they're doing becomes very high. So they're actually doing incredible. So those are markets that are doing incredible. For instance, like if we go to 1990, that's Hawaii. So Hawaii is like the top state at the time. They're 150% up from their previous, whichever in that market cycle, like 150% up. They're the top market. Nobody would easily imagine, unless doing this kind of fundamental analysis, that, okay, their prices are going to be lower 8 years later. And they're going to have the weakest price performance for the following decade. That was the strongest performer at the time. And so this is that's why fundamental analysis is extremely important. And similarly, if we go to the global financial crisis, so the overvalued like California, Arizona, Nevada, and Florida were the 4 big overvalued states at the time. So you can see in the table there the worst bottom performance consistently year after year for 10 years ahead. And so that's extremely important. On the contrary, someone invested in undervalued markets at the peak of the global financial crisis, they outperformed. They didn't perform great. They still performed. It's still let's say 20% over the course of 10 years is extremely poor performance. But it was not negative, it was better than the others. And so they outperformed. And yeah.
So what I want to just say, because there are a lot of people that can't see this.
Absolutely.
What he's saying, and this isn't true of the whole state. California is a huge state. So there are definitely different pockets that perform differently. Same with Texas, right?
These here are statistics for the MSAs, the metropolitan areas.
Got it. Okay.
Not states, actually.
So what he's saying is that, say, for instance, California was 52% overvalued. If you look at this chart, it went down 50% in 5 years, but then its recovery up to 10 years took it to just 25% down. So it was still a negative 25%. But then if you look at some of these other markets that were maybe 6% overvalued, or the other one he just pointed out was a 3% overvalued, they went down initially during the crisis, 1 or 2%. One of them went down 3%. But then after 10 years, they had gone up 18, 27, or 17%. So as opposed to in these really highly overvalued markets that are still down 25% from when the crisis started, in 10 years, they're still down 25%. In these lower valued markets, they might be up. So they went down a little bit, but their recovery was not phenomenal, but at least it was a recovery. We weren't in negative. We were closer to 18 or 19% up after 10 years. So that's what he's showing me in these charts. I hope that was okay that I kind of...
That's a great summary, Moneeka. And thank you for that. And yeah, and just again, like that was just like showing some numbers, but it's not really, I don't want to focus on like too many numbers. It's just like the big picture intuition of it. And so the big picture intuition is valuation is extremely important in general, but it is like super even more important than the turning points in the market cycle. So, so when we're at the peak of a market, it's the most important variable that overshadows fundamentals themselves. Because at the other times, okay, I'm going to be forecasting fundamentals. That's how I get to the best appreciation. And again, like the goal of this, it's not like a doomsday thing. It's more like my goal is where do I get the best appreciation? That's what I care about. I want to continue investing. And of course, like people as commercial investors or residentials, we do our forced appreciation. As good business people, we generate our business profit in this way by being quality investors on the forced appreciation side, right? That's always there. So you do that well in a recession, you do it well in other times and so forth. But you still don't want to have the effect of markets overlay or kind of like on top of that, right? And so that is kind of like the effect, that is kind of the goal here. And so that's why I want to show this like very complicated, like many numbers table to kind of point, again, like just to listeners to point that across different levels of overvaluation ahead of a recession in both a mild and the severe recession, where one is very, very mild, like 1990, and one is very, very severe, like the global financial crisis, the undervalued markets at the time outperform. And that is a very big shift in what most investors now are thinking, because, for instance, if one is investing like in an extremely booming market, I don't know what would be, Austin, Texas, let's say Austin, Texas. And so that's an extremely booming market that has like very strong fundamentals. But if it happens to be Austin, Texas is overvalued, then that overvaluation is defined relative to those fundamentals. And then some investors say, okay, there's housing shortage. So they say, okay, there's so much housing shortage, real estate is not going to decline because of housing shortage. Right? Almost. That's not true, because housing shortage depends how you define it. Okay, now if you take the broad housing shortage, which is U.S. Census Bureau total population in that market versus U.S. Census Bureau housing supply in that market, that is reflected actually in the numbers that I'm showing here, because they're reflecting kind of income, and they're also reflecting like population to housing supply ratios. And so that's actually kind of reflected, and that's not and if you have prices above that, well, okay, Austin, Texas, it is the very, very best market. But if prices ran too forward, it's going to underperform. And so that's a very consistent observation. So these are around 400 metropolitan areas here. And these are two very, very different recessions. And again, like investing in a 50% plus overvalued market, which is likely to be the top performer, the current market cycle, is likely going to kind of have a reversal in price performance. That's kind of the piece. Yeah,
you're right. So, that is so not intuitive. You think that a strong market, once it goes through a recession, will continue to be strong. That's very, very interesting. The numbers prove out to be exactly the opposite.
Well, I mean, it depends. Now, so you make a great point, because, I mean, again, it depends. Like in itself, a strong market, yes, would recover better. And so that is even like the comparison of 1990 recession versus global financial crisis. It's like, why in 1990 you have markets that overvalued, some of them, very few, but they're overvalued 40, 50%, and they only drop, like 15%. So the reason is, it's not that global financial crisis was a crash of sorts so much, quote unquote crash. It's that it was a severe recession, that the recovery of fundamentals was very weak. And over the course of prices declining, which took 4 years, that's because I know you did mention like very sharp decline in some months, and like I feel terrible for that, and that sucks. But that's it. Still, like on the big picture, declines took like whole 4 years, prices still kept dropping.
Yes, right? Absolutely.
Right, exactly. And so for those 4 years of declines, what happens in a mild recession is that the fundamentals are strong and they catch up. And even though the market is overvalued more, it ends up declining less. So kind of just because there is a strong recovery. It's not that one is a crash and the other one is, well, not a crash. It just depends on how severe that recession is and how strong the economic recovery is from a fundamentals kind of perspective. That's at least like kind of my perspective. And so, yes, from this standpoint, it's true that a strong market would recover, that recovers faster. And that does happen in some markets. I completely agree. May be overvalued and may recover very fast and very well and get a very small decline. And that is possible. But the question for me is, again, it's not only like kind of predicting downside risk, but it's more like, how do I forecast appreciation at the peak of, let's say, at the peak of, let's say, if there is a recession. We don't have a recession actually yet, so that's all hypothetical. There's no officially declared recession still, right? In a way. And so, but if we were to have, like, how do we forecast appreciation? Where is going to be the best appreciation? In which metropolitan statistical areas? Is it going to be in the booming ones? Is it going to be other ones? And so what this is suggesting is it's not going to be in the booming ones anymore, and they kind of would underperform. And so that's kind of, the reason is valuation. And again, like I can go over like valuations like in different also like cities and things like that. But that is what the study suggests. It's a very different scenario. For instance, we had a recession such as the dot-com bubble in 2001.
2001, exactly.
Right. So I've studied that one too. Let's say the dot-com bubble. So it's a very different scenario if we have that one and there isn't any significant overvaluation in the market, which there wasn't at the time. And so markets then just basically nothing happens because they're mostly all fairly valued and things just continue going forward. Mm-hmm. And that's what happened then. They continued going forward and then they became overvalued ahead of the global financial crisis and that. But it was a very fairly valued period.
It was very fairly valued, but we had a lot of people that lost jobs. So people couldn't afford the homes. Okay, so we did see the markets pull back a little bit just to accommodate all those people that couldn't get homes. Rent went way up because people's credit got screwed up, right? So there was some other issues that happened there that did cause the market to go down a little bit. Wouldn't you say? They're not strictly statistics.
Right. At least in could have been perhaps in like new listing prices or like some of like the more transitory kind of data of sort. Mm-hmm. But it appears at least in the official, like the recorded statistics for prices, then they kind of are showing no decline, like nowhere.
Interesting.
It's quite interesting. Yeah. Like almost like another single city. And
interesting because so this is the difference between real life and statistics, right?
So that's okay, good. That's
so I want to talk about 2001. So 1990, I'm sorry, I was mistaken when I said we lost valuation on that one. I do remember that. I was in college. So I was listening to my dad and sort of what happened there, but I wasn't myself personally involved. 2001, I was personally involved. In 2008, I was personally involved. In 2001, it was interesting. So it was a dot-com crash. So it was definitely in the Silicon Valley, which is where I lived and where I owned all my homes. So I think that this is a very market-specific thing, is that during that time, so many people in the Silicon Valley, because of the bust, so many people lost their jobs, or they had this weird thing that happened with stocks that you would get, if you would get laid off, you would have to exercise your stock and then you owed taxes and they couldn't afford the taxes. So they would have to either sell their homes or there were some weird things that were happening in the Silicon Valley. And so your numbers are probably national. So what I know is specifically here. But what was interesting to me, so property values dropped about 20%, just so you know, during that time, they recovered very, very quickly. And interestingly, rents went up dramatically during that time because people that would normally buy were not able to buy anymore. But when you say that when you look across all metropolitan areas and you didn't see anything, that's interesting to me because San Francisco, San Jose, Sacramento, those areas are big metropolitan areas in California. And they definitely saw they didn't see what we saw in 2008, but they definitely saw some discomfort. They recovered quickly, but there was definitely some very, very distinctive discomfort.
Right. I mean, yeah, that is extremely interesting. Because I mean, if you think about like real estate prices, like they don't always, you could have like a change in value and it's just not, let's say it doesn't show, let's say just due to liquidity, there's illiquidity. So sometimes it could be that no transaction. Right. But the price at which those transactions would happen would be lower. So it's kind of like in unrealized terms, there could be a big decline in unrealized terms. Let's say something like COVID, but in real terms, then, but the thing is, it's interesting that
I just want to say right there, ladies, what he's talking about is what I always say is you don't lose money and you don't see the valuations change until selling happens, right? It's all on paper. That's all. I just wanted to add that in there.
Exactly. And but no, actually, I mean, that's the data that is, and that's like Federal Housing Finance Agency, but the government or the main governmental agency following like U.S. prices. So the specific thing for 2001 is actually the 400 or so metropolitan areas in the U.S. And so, yes, there are San Jose and like San Francisco, however it's exactly defined the MSAs. And they don't have the kind, which is interesting. But then you did experience it in real life, so that's like quite interesting because
it is interesting. That surprises me. So,
yeah,
wow, that confuses me a little bit. Like, how is that possible, right?
But then on the other hand, because I mean, it's interesting. That's kind of what you observe. But on the other hand, we haven't heard anyone else say about any real estate declines in 2001.
Well, but what is true, Stefan, is I think that anybody that could hold did. So rents were going up so fast. Like my property dropped 20% in value during a couple of years. That not immediately, but over those 2 years, recovered quickly. But during that entire time, rents were going up dramatically. So I could hold the property. So when you're talking about it, only the numbers are only going to show when people sell. Maybe people were holding. What do you think? Is that a possibility?
Or maybe was it so it was a multifamily perhaps?
I was single family. Mine was all single family.
Very interesting.
Sorry to challenge you, but it's interesting, isn't it?
Yeah, that's it. This isn't very interesting. Yeah, it is because it could be segments in the market or
possibly
it could be in neighborhoods. I mean, still that's the whole MSA. Well, I guess that's like perhaps what is happening. Perhaps like you're saying with the .com bubble, with some people losing their jobs in some regions in Silicon Valley, perhaps some neighborhoods, kind of had declines and others still continued going up. And so sort of like kind of flattened out in the metropolitan area. Because I mean, this is still pretty high level. It's still the home metropolitan area.
Got it.
But I mean, that one that did not have declines in not a single metropolitan area, by the way.
I love that. Okay, that's so interesting.
But again, but that's you're making a very good point because again, like, see, if your property declines or your neighborhood declines, doesn't matter, right? You have the same effect. It doesn't matter what the market did, but. Right. Yeah, it appears that perhaps other neighborhoods did better or something like that.
Well, but what's also interesting to note is that, like, what I'm learning from this, Stefan, is that what I noticed is that the market went down, but then it recovered very, very quickly, right? Rents went up, so holding was easier. So what I love about this is that as you talk about the statistics the data, forgive me for that, but the market data show that there was no real decline. So I was in a pocket where I experienced a decline. As long as I held, I had time to be right? But it was still a good time to buy. And this is such an interesting thing for people because people are asking these questions right now every day. Is it a good time to buy? The markets feel overvalued. Interest rates are going up. I want to capture the lower interest rates, but markets feel overvalued. Is it a good time to buy? And I think that your statistics show that even during that time, it was an okay time to buy because everything was valued fairly, right? So even though I personally experienced a decline and many of my friends did in the Silicon Valley, in this little bubble that we were in, it recovered very quickly. We were able to hold and it was still a good time to buy. Even then, the recovery happened very quickly, even though you saw a dip. So that's kind of what I'm taking from that. What do you think?
Yeah, I mean, I agree. I think that, again, like, if we think of, because I mean, whatever you make it, that's a great things actually that you're making, great points there. Because if we think of what we're doing here, they're just very high level fundamental analysis, right? Now, if we start making it super granular, it's even gonna be working less well, I suppose. Now, if we go to like super tiny neighborhoods and we try to do kind of fundamental analysis, it's not gonna work too well. Absolutely. Like, for instance, my data, counties predictive power is less strong than states' predictive power. But it happens with metropolitan areas for some reason. And I don't know if it's quality of statistics of those versus counties or something like that. Metropolitan statistical areas have extremely high predictive power. And so that's like kind of a little bit interesting. But I'm sure if I went to zip codes or like neighborhoods and so forth, it's going to get get harder because there's going to be so many, perhaps like many other factors and so forth. But then you're making a point, there's also the liquidity thing. So these are like quarterly governmental price statistics. That's all it is, kind of a point. If your price dropped for 2 months in between and jumped back to the same level, then that's not even detected, right? Or if a neighborhood dropped, other neighborhoods increase. So it is true. So it is kind of smoothed out. But on the other hand, for kind of fundamental analysis like that, perhaps we want it smoothed out, because if it wasn't, we don't want too much. It's not even going to be tying to fundamentals if it's too not smoothed,
Absolutely.
Because it's like these other things that are either way not fundamental. And so that's kind of, I think, like the thesis there. But yeah, of course, I think you make a great point that it is not applicable to where your property can still decline or your neighborhood can still decline. It's just the broad market.
And you were talking about basically appreciation of the properties with these statistics, right? So we're not talking about increases in rents or any of that stuff, right? Because those are different numbers that are right. In a lot of these stable markets, rents continued to go up. So they're even though they didn't appreciate as fast, they didn't go down as much, they didn't appreciate as fast, their rents went up dramatically. So when you're looking at like which markets to invest in, you want to look at the statistics of whether the markets are going to appreciate, whether they're going to take a hit when the markets go down, right? When we have a recession. But you also want to keep in mind, now you've got some markets that you're interested in, you want to keep in mind, and what are your cap rates, right? What are the rents looking like and how are those going up? Wouldn't you say?
I agree. Yes. And that is a great point, especially for commercial multifamily investors, right? So that we've seen that very much in the current period with, humongous rent growth in some markets. And yes, those are different dynamics, because like if we think of like cap rates in the commercial space, they're driven in a theoretical sense. So they tie to something, and I don't want to go like too much, they tie to something in finance that's called the dividend growth model. Yes, and they tie to like, it's like the denominator in that one. It's kind of like discounted cash flow analysis for commercial property. And so they essentially are driven by there is interest rates there is kind of the risk-free rate, and then kind of like risk premium on top of that. But there is also what is reducing the cap rates is the expectation of future income growth. And that would be the same for any business. That would be the same for valuing other companies as well. That wouldn't be only for commercial real estate. It would be the same methodology, just that methodology derives from kind of like what is like, it's a mathematical thing, like a series sum in a discounted cash flow analysis of any company or any business or any property. And so yes, so rent growth is extremely important, and that drives cap rates in a theoretically kind of valid way. And that is a whole different dynamic. We've seen that in the commercial multifamily space.
We see it in single family homes too. Like if you're out there buying a portfolio of 10 homes, or for me, whatever I own, right? We see that in the cap rates also when we're buying a single family home. How is that? So we want the property to appreciate, but we also want to know that we're going to be cash flowing within a certain number of years, hopefully right away. Those sorts of things actually matter, right? And like I said, when we had our bubble burst here in the Silicon Valley, it was the rents going up that saved us from having to sell, right? Because we could carry our mortgages still. So
correct. Yes.
I feel so, Stefan, this is so interesting, and I feel like we could talk forever, but we're running out of time. So what I'd like to do, first of all, thank you for all that information. You kind of blew up my brain. I'll have to listen to this again, watch it on YouTube again. And ladies, you do the same. There was a lot of really good information. But what I really want to talk about a little bit is, let's talk about the states right now. Who's overvalued? Who's undervalued? Where are the opportunities? And where should we stay away from, right?
Yeah. So you want me to touch on for different states, for example?
Yeah. So which cities and states are overvalued right now, and where are some opportunities? Okay. And like we've got 5 minutes, so I'm so sorry.
So let's go like right quickly. I mean, yes. So just to clarify, it's the numbers, and I'm just sharing my screen here with like a map of the United States showing like different states, and kind of in darker color are the ones that are more overvalued, and lighter ones the ones that are less. And so just like your perspective, this is as of the end of the first quarter of this year, because
this year 2022,
but only the first quarter. Second quarter hasn't come out yet, because because that's fundamental analysis based on the governmental statistics, income, population, housing supply. So those come out slow. So those take time. We have the prices, but the governmental kind of fundamental statistic they have. So that's the first quarter of this year. Now it's not going to be too different. The second quarter changes a little bit, kind of has kept increasing. But what's important to note is US real estate was quite fairly valued even through the first quarter of 2021 at the broad level.
This surprises me a lot.
Right. So that's a surprise. And that was actually reported. The way to see that at the country level, there is a study by Niraj Shah at Bloomberg Economics. He had it for different countries in 2019, and it came out in the beginning of 2021 as well. And US real estate, they look at different metrics, has price income ratios, for example. And that's a good one. I can explain why that works well and so forth, but another discussion. And so the first was around zero. That's very contrary to some countries, other countries, for example, what is referred to the SCANS economies. So that's Sweden, Canada, Australia, Norway, New Zealand, that were very overvalued already since even as early as 2018. And they still don't decline because there are such economic conditions. There's no trigger for them to decline. There are low interest rates and so on and so forth, but they are overvalued since then. That's driven by central bank policies in what are small, closed oil exporting economies. And their real estate has been reported to be very overvalued, and that's with Bloomberg Economics and other sources. But US real estate was fairly valued, and I had it in my data as well as fairly valued. And I started doing this since 2020, the beginning of COVID on my end at Realty Quant. And again, this is data published at realtyquant.com. So as late as 2021, the first quarter, US real estate broadly at the broad level was close to 0%. It's incredible.
In 2021 first quarter?
2021 first quarter was still close to 0%. Now, if we take US real estate broadly at this data that you're looking at the map for people who are on YouTube, it is actually around 13%.
13%
overall, only if you take the whole US.
The whole nation.
The whole nation would be only 13.
That's phenomenal. That's amazing.
Right. But it's not a small number, because if you take the global financial crisis, it's the same data, the governmental FHFA data. Global financial crisis in the same one would be at plus 20. So that's already at 2/3 of the global financial crisis. Mm-hmm. And you have to keep in mind that at most other time periods, and that's history for 45 years back, at most other time periods, US real estate tends to be even slightly undervalued. And so this is a material overvaluation, but that is at the whole level. Now, the whole level doesn't so much matter to particular investors. If you go to specific states and so forth, it gets more overvalued. So the reason is because we have undervalued Illinois, we have undervalued, forgetting the whole list of, fairly valued New York, Pennsylvania, New Jersey, and so on and so forth. And so, but if what is overvalued, so Idaho is above 50%. So Idaho has been the leader. Then the states of Nevada, Utah, Arizona are above 30, and we have Texas, Florida, Colorado, above 20. There in total 10 US states Q1 of this year above 20% overvalued.
Interesting.
So they're all Western and Southern states. So that's Idaho, Arizona, Utah, Nevada, Florida, Washington, Texas, Colorado, and Montana. On the contrary, if we go to the very kind of the opposite end of the spectrum, what's undervalued, and I'm not saying that's necessarily desirable, that ends up being desirable over the next decade, as we saw in that picture, but not necessarily until a recession hits in that period, no. And so the undervalued ones are sort of not well-performing markets that are, Illinois, North Dakota, Louisiana, West Virginia, and Connecticut, that are not trendy, that are actually poor in their fundamentals. But they do tend to carry less downside risk simultaneously in a recession, just because they didn't get overheated. Mm-hmm. So that is, in terms of cities.
So he's showing us a lot of different charts. Ladies, really, you should go to blissfulinvestor.com and check this YouTube out. It's worth looking at.
So Boise is at the top. So Boise MSA, Austin, some other MSAs in Idaho, so Nashville, Phoenix, Tampa, Dallas. Very booming, very strong markets. Again, that's not being bearish. They're incredible markets. Mm-hmm. They're incredible people who made fortunes in those markets, and that's completely true. But they do happen to be overvalued now, and that's very much in the past 1 year. Things accelerated with inflation. Mm-hmm. And so those are some kind of overvalued cities. And have at the county level, perhaps some other ones that can quote like based on like county data as well. And I mean, that's I think a good list is kind of like around like the top 10. And again, but I think the important thing to note is also say it's not that it's predicting necessarily big declines in something. So let's say Boise overvaluation is at 74% right now. That sounds very high, but it's not like, so if we experience severe recession, like Wolf America, that would be a decline. So I have predicted declines of like different scenarios. Let's say if we have a like GFC-like recession, which nobody expects, right? They don't either. But let's say, so then the decline for Boise of a 74% valuation would be 46. It's a big
That's
decline.
if we have a huge crash in the market. That's right. That's right.
If we have a mild recession like 1990, then the decline, even though it's overall at 74%, because the recovery is going to be so strong, the decline is only 18%. But to clarify, that overvaluation is still a real thing, because that 74% overvaluation, I tracked those historically for like 45 years. That number is going to go to zero. It always does. So it's not that number is just fictional. And like some of my friends, they might say, what if something is overvalued, it just stays overvalued? That doesn't happen. It doesn't stay. It doesn't stay overvalued. It will go to zero in valuation terms. It's just that if prices don't decline too much because we have a very strong economy or like strong recovery, then the decline ends up 18%. And because that decline takes a really long time, let's say it takes 6 years or something like that. Typically, especially if it's like for small declines with big overvaluation, tends to take a long time, could be even 8 years forward. And so that decline takes a long time. Over these 8 years, humongous period of time, incomes increase, like population to housing supply ratios change in whichever way they change and so forth. And those fundamentals shift in a way that they compensate that valuation, they drive it to zero. And so that is a strong recovery case. But this is just an example of what could happen. If we take in the case of Austin, Texas, an incredible city with hugely strong fundamentals, but though exceeded by current pricing. So what would happen there is so its valuation is just one moment. I had it on the spreadsheet is like it's at around like 66% overvalued roughly. And so the model for like the severe recession that I have, it has like a 40% decline in a severe recession and only 15% in a very mild recession. And so again, so those are all possible. It's not a doomed thing, but I think what is really more important, that's like for me, because like I'm a very positive, eager investor who wants to continue investing my funds in a recession as well. What is important to me is how do you make a model to forecast appreciation, and what is the best one? And so what here it's suggesting is even without incorporating in the model fundamentals forecasting itself, but just purely looking at market valuation, that's the big table with lots of numbers that I showed, just purely looking at market valuation at the peak ahead of a recession, so to say. And what that's suggesting is that even just by that, if one just took this simple model and invested in the undervalued MSAs, so those would be very counterintuitive at the time. Those would be MSAs like San Francisco, like San Jose. They're undervalued at the time with population issues, with all kinds of issues. But purely what the history suggests from those two very different recessions at very different times in U.S. economic history, if you will. And they, in both of those cases, the very lowest buckets of most undervalued metropolitan areas outperformed over a decade forward. And that is extremely interesting for me because we have to keep in mind they were actually performing poorly at that peak. That's why they were undervalued at the time, even in a way, because it's a mix of also weak fundamentals and even they're even below, the prices are even below those weak fundamentals. But they do tend to have weak fundamentals. There's a strong correlation between how strong a market is and how overvalued it becomes towards the end of a market cycle, so to say, just kind of by overheating, like investors picking up more stuff there and so forth. And so that's an interesting thing. And so for me, like this is like the perspective, how do you forecast appreciation in those? And so that's kind of why I went to show the table. I think it's an interesting thing because again, like it becomes very counterintuitive because that's shifting the whole expectation of investors and how we are now accustomed to like the West and South is the booming places and how that could shift in the next market cycle and how it's perhaps statistically likely to shift in the next market cycle.
Wow. That was awesome. How can people get more information. I know that you've got a free report. It's the free state level market valuation report. Ladies, if you want to get that, I think I actually looked at it. It looks very similar to what he just showed us on the screen, right? So to get that, go to blissfulinvestor.com/markets. So it's plural. So blissfulinvestor.com/markets, and you can download that. You can also go to YouTube and take a look at what he just showed us on the screen. So those are some ways to definitely get more information about that. But how can they reach out to you?
Yes, absolutely. So my website, realtyquant.com. So that's the best way to reach to me, as well as they can read my blog about like some of the things we discussed now. They can look up our data that we have there for like basically 2,700 US counties. And I also have a YouTube channel. It's my name and Finance Meets Real Estate on YouTube. It's a weekly webinar that I run.
So that'll all be in the show notes. So we don't have time for 3 rapid fire questions. We are going to try to do an extra. We'll see how this goes. But stay tuned if you are subscribed to Extra. And if you're not and you're leaving us now, thank you so much for joining Stefan and I for this portion of the show. I appreciate you. I hope it was helpful. And I look forward to seeing you next time. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you soon. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.